Summer cash flow panic at your preschool or childcare or play cafe, that isn't a sign that your business is failing. It's a sign that your business is seasonal and you've been managing a seasonal financial reality with a year-round financial plan. You've checked your bank balance in August and you wondered if you made a terrible mistake building this business, even though September fills right back up. Here's what confident early childhood operators understand. That summer cash flow, it is a pattern to plan for. When you map your summer financial landscape, build a buffer before June arrives, and stabilize your revenue structure, you can lead through your leanest season without the panic that it's been stealing your peace of mind. Well, hey there, CEOs. Welcome to this week's issue of the Early Childhood Business Made Easy podcast. I'm Kelly Peak, and I love to help you find more of that time, freedom, and profit that you so deserve, my friend. Now, I want you to picture a moment that I'm guessing might feel a little familiar. So it's Tuesday morning. It's the first week of August. You sit down at your desk with your coffee. I know it's a skinny latte for me. Open your banking app, and there it is. The number is lower than it should be. Not dangerously low, but maybe lower than it was in March, maybe lower than it was in April, lower than it's been in months. And even though somewhere in the back of your mind, you know this happens every summer, that number still hits you like a punch in the chest. For about 90 seconds, you wonder if you've made some kind of fundamental mistake, if something's broken, if enrollment next year is going to hold. And then the kids start arriving, a parent stops in with a question, and you push that number out of your mind and you move into the day, promising yourself you're going to figure it out later. Does any of that sound familiar? I know because I have been there. And so has nearly every other early childhood business owner I've worked with in the 30 years of operating and coaching in this industry. Early childhood businesses are not steady state businesses. We are seasonal businesses. Our revenue flows the school calendar. It flows the summer weeks. It flows programming and patterns that are fundamentally different from just school year enrollment. And when you try to manage a seasonal business with a flat year-round financial plan, that's when you're going to experience that August bank balance moment every single year. But the good news is that it's completely fixable, and it's not by working harder in August, but by planning a little differently in April. So today we're going to talk about 3 strategies to help you take control of your summer cash flow before summer arrives. We're going to cover how to, number 1, map your summer financial landscape so you actually know what's coming. Number 2, build a financial buffer before you need it. And number 3, stabilize your summer revenue so the dip is smaller and more predictable than it's been. Now, I've got a brand new free resource for you today with this particular episode. It's the Summer Cash Flow Planning Worksheet, and it's designed to walk alongside with you everything that we're talking about today. So go grab it at kellypeak.com, where you're going to find information about today's episode 185. Now it's time to stop dreading August and start leading your finances through the summer season. Summer cash flow, it's not an emergency, it's a forecast. The early childhood operators who lead their finances through summer with confidence, they're not just lucky, they're prepared. And that preparation really does start months before June. Now, here's something 30 years in the industry has taught me. The August bank balance panic, again, it starts earlier than August. This is when you decide not to look at your summer financial projections because you're too busy running the business. That usually happens in April, May. But you really need to make time to look at your business, even though I know you think you're too busy. I've worked with operators who had genuinely profitable businesses and still experience a summer cash flow crisis. Again, not because their businesses were underperforming, but because they had never really mapped out what summer actually looked like on paper. They were reacting to a pattern that they could have predicted. The operators who break this cycle, they're not the ones that are really better at finance. They just decided that at some point, that understanding their own numbers, that was a non-negotiable. And once they could see the pattern, they planned for it, and that became the norm. Childcare Aware of America reports that small early childhood businesses, those operating with less than 50 children enrolled, are among the most financially vulnerable service businesses in the country, with more than 60% reporting that cash flow irregularity is their single greatest operational stressor. The McCormick Center for Early Childhood Leadership has documented that summer revenue fluctuation in center-based childcare averages between 20 and 35% below peak month enrollment revenue. 20 and 35% below peak month enrollment. This is a pattern that repeats with near perfect consistency year over year unless something is done. What this data is telling us is that summer cash flow stress, it's not a personal failing. It's a structural characteristic of our industry, and a structural problem that requires a structural solution, not harder work or tighter belts in August. This requires plans that are built in advance. Now, there's a preschool director that I worked with here in the Pacific Northwest, and she came to us 2 weeks after one of the most stressful summers she's experienced in her 8 years of operating. Her enrollment had actually been strong. Summer programming was full, but she'd spent the entire summer in financial anxiety because she had no idea what her numbers were supposed to look like, which meant every week felt like a potential emergency for her. And so when we worked together to build her first real summer cash flow map, oh, wow, the look on her face, it was just something I'll never forget. She said, "This is what was going to happen anyway. I just didn't know it." The revenue dip that she had panicked over all summer, it was actually smaller than what she had projected once we mapped it out properly. The fear had been bigger than the problem. And that following spring, she built a 6-week operating buffer using her April and May enrollment revenue, and she put her summer financial projections on paper before May 1st. So that August, when the number in her bank account looked lower than spring, she didn't panic. She looked at her projection. She confirmed the dip was in the expected range, and she got back to operating her business. She reclaimed so many hours of mental bandwidth and led her team through summer with clarity and calm, something she'd never really experienced before. That is what financial preparation makes possible. So, my friend, we are going to go into those 3 strategies, and we're going to start with strategy number 1, the mid-year cash flow reality check. So before you can plan for summer cash flow, you need to understand your summer cash flow and what it actually looks like. And this is the step that a lot of people skip because looking at your own financial data, well, I know, I get it. It can feel intimidating. There's a fear of what you're going to find. And your fear is that it's going to be worse than what you imagined. But honestly, in my experience, the opposite is almost always true. The pattern, once you see it clearly, is almost always more manageable than the anxiety it was producing. The mid-year cash flow reality check is a simple 3-part exercise. Part 1 is revenue mapping. So pull out your bank statements, your accounting software, your payment platform reports, whatever you use for the last 2 or 3 summers, specifically June, July, and August. And then for each month, write down your total revenue. You're looking for a pattern. Which months dip lowest? Are there specific weeks that you're consistently lightest? And how much the gap actually is between your peak spring revenue and your lowest summer months. Now, some operators who do this exercise, they discover that their actual summer revenue dip is way smaller than they feared, and it's more predictable than they realized. Part 2 is expense mapping. This is where EC businesses often have an advantage over other industries because many of your expenses, well, they're relatively fixed. Your rent doesn't go down in the summer usually. Your base payroll usually stays consistent if you're offering summer camps and summer programming. Your insurance, licensing fees, and utilities, those are usually pretty predictable. So map your fixed monthly expenses on paper. Separate from your variable expenses like those random supplies, your substitute labor, maybe the programming costs that come with specific enrollment. Your fixed expenses are your cash floor. That's the minimum monthly outflow your business carries regardless of what's happening with revenue. Part 3 is the gap calculation. Now, once you have your summer revenue pattern and you have your monthly expense floor, calculate the gap. And your lightest summer month, how much is revenue below your expense floor? Now, that number multiplied by the number of months where the gap exists, that's your summer cash flow need. This is the number that determines the size of the buffer you need to build. So one important note for operators running ratio-dependent businesses, your team costs are the variable expense that moves most significantly with enrollment. So if summer enrollment drops, you should be able to reduce your team hours accordingly. But that flexibility into your expense map is what you're going to need and add to that calculation to make sure everything is accurate. Now, the summer cash flow planning worksheet that's included with this particular episode, it's structured for all three parts of this exercise. So section 1 of the worksheet walks you through that revenue mapping, your expense floor, and your gap calculation in that fill-in framework. So go grab that at kellypeak.com, where you're going to find information about this episode, podcast 185. And then I have your 2 action steps. Number 1, pull your bank statements or your accounting reports, whatever you use for June, July, and August for the past 2 to 3 years. Create a simple table showing your monthly revenue for each of those 6 months. Don't analyze it yet, just get it on paper. This is your summer revenue map. And then action step number 2, calculate your monthly cash floor. That's a total of your fixed, non-negotiable, those monthly expenses, your rent, base payroll, insurance, utilities, loan payments. Write this number down somewhere visible. This is the minimum your business needs to generate each month to stay operationally healthy. And it's the anchor for everything else we're going to build. On to strategy number 2, building your summer cash flow buffer. Now that you know your summer gap, let's talk about how to fill it before you need to. This is the strategy that's going to change everything, and it's also the one that requires a little more lead time, which is why I want you to hear this now rather than later on. Building a summer cash flow buffer means deliberately setting aside money during your strongest revenue months. Now, this is typically February through May. We are later into the year, but I want you to know this so you're prepared and ready for next year. This is specifically to cover your summer gap. Now, this isn't a new concept. This is business finance. But what's different for early childhood businesses is that the window for building this buffer, it's a little more narrow because our strong revenue months, they're concentrated. And summer, well, it arrives before you know it. Now, there are 3 approaches that work well for EC businesses specifically. The first is the spring enrollment reserve strategy. So if you collect tuition payments in advance, whether that's monthly, biweekly, or weekly, you likely have a spring period where you're collecting more revenue than you're spending on direct programming costs. So identify the surplus in your April and May P&L and make a deliberate decision to route a portion of that surplus to a separate savings account or reserve line item. In our profit first methodology that we use, we call this our tax and emergency fund. Now, the act of naming it and separating it from your operations account is more powerful than it sounds. Out of sight, but yet it's available when you need it. So if you leave it just in your operational account where all your other bills are paid, that's where the leaks happen. So pull it out, put it in your tax and emergency fund. Or if you have the bandwidth, create a totally separate account just for your summer. Now, the second is the deposit leverage strategy. So if you run a summer program that families register for in advance, your summer enrollment deposits are essentially pre-collected revenue. You could structure your deposit policy so that the summer deposits are collected by March 1st, giving you a clear picture of your summer revenue floor before you need to finalize your team plans. Now, March 1st might be a little early, but definitely by May. Now, the certainty this creates is worth as much as the cash itself. And the third is the CEO profit spotlight approach. This is one of the most common discoveries early childhood business owners make when they do a careful financial audit is that there's revenue they are leaving on the table. Services priced below market, fees that haven't been updated in years, unenrolled spots that aren't being actively marketed. So before you plan your summer buffer, do a quick profit snapshot to see if you are already generating more buffer building capacity than you realized. So the CEO profit Spotlight guide, which I'm telling you about in just a moment, that was designed specifically for this kind of exercise. It walks you through a financial snapshot that's going to help you identify where your business is generating profit, where it's leaking it, and what are 1 or 2 adjustments you could make, and what would be the most meaningful difference to add more profit to your bottom line. So it's a small offer available at kellypeak.com. You'll find it under the tab Shop Resources. It's one of the most practical financial tools that I've built for our early childhood operators. Now, your buffer goal at minimum is 6 weeks of operating cash at your cash floor amount. So this means if your monthly fixed expenses are $15,000, your summer buffer target is going to be approximately $22,500. Now, that number for some of you might feel a little large, and that's okay. Start with 4 weeks then. Something is always better than nothing, and the habit of building any buffer, even a small one before summer, that's the experience you need during this season. Okay, 2 action steps here. Action step number 1, open that separate account or move your money to your tax and emergency fund and create a clear accounting line item and transfer whatever you can this week, even if it's a small amount. The structure matters more than the starting amount. Now, when this account exists, you will fund it. If it doesn't, the money disappears and leaks into your operations. Action step number 2, calculate your 6-week buffer target. So take your monthly cash floor from strategy 1 and multiply it by 1.5. Write this number on a sticky note and put it somewhere where you are going to see it daily until you reach it. Give yourself a deadline to have your buffer fully funded before summer begins. Strategy number 3, the summer revenue stabilization plan. Now, the first 2 strategies are about understanding and preparing for your summer cash flow reality. And the third strategy is about changing that reality going forward. The summer revenue stabilization plan, it's a set of intentional decisions about how you structure your summer programming, your pricing, and your enrollment policy specifically to reduce the revenue gap and make your summer financial picture more predictable. Now, this is where the CEO mindset makes the biggest difference, because most of these decisions are ones that operators avoid because they feel uncomfortable or they feel it's risky. But not making them is what creates the annual August panic. There are 3 stabilization levers available to almost every early childhood business. The first lever is your summer enrollment structure. So if you currently allow week by week drop-in enrollment for summer programming, you're building your summer schedule on sand. Families who drop in and out, they make it nearly impossible to project your revenue, maintain your ratios, or plan your team staffing needs with any accuracy. So moving to a minimum enrollment commitment, whether that's a 4-week minimum, a monthly commitment, a full summer registration, whatever that is, it's going to give you a revenue floor you can actually plan around. So will some families choose not to enroll? Yes. But the families who commit to a full summer enrollment or a full week enrollment, those are going to become your most loyal families, and your business will be more stable without that chaos of week by week, day by day scheduling. Now, I want to throw a little caveat here, because for those of us who have a stronger, more consistent program, we do both. So for example, at Peak Academy and Play Boutique, we do offer day by day and week by week because we are 70 to 80% full for summer camps before summer even begins. So because we're already so full, then we offer that day by day, week by week to fill in the extra spots. So what I'm suggesting here, if that's all you do is the day by day and week by week, that's what's going to drive you crazy. So get your situation and get your programming to where you can offer at least 50% consistency. Then you can open up to offering that more day by day, week by week. Now, the second lever is summer programming diversification. So if your summer revenue depends entirely on your standard enrollment, you have one revenue stream in a season when that stream might run lower than usual. So consider what else, your space, your team, your expertise, something else you could generate during your summer. So again, that's where summer camps come in. Theme week upgrades at a higher price point, a summer enrichment series that appeals to maybe older siblings, or maybe on a specific topic like piano or art, or maybe a summer family membership for your Play Cafe as part of your business model. Now, you don't need to add all of these, just choose one. And the third lever is your billing cycle and your deposit structure. Now, this is the one that operators overlook most often, and it can be meaningful to front load your summer cash flow without changing a single thing about your programming. So if you're currently billing families at the end of the month for services already delivered, consider moving it to a beginning of the month or a beginning of the session billing model specifically for summer. Combined with a non-refundable summer enrollment deposit collected in the spring, this can shift and move those weeks of summer revenue into your spring collection window when your bank balance is strongest, and then you can add that up. So for example, many of you have listened to me for a while, know that we bill in summer in June and July. So we bill June 25th for July and July 25th for August. So we're always billing ahead, which means we have money in our bank by the 28th before all of our bills are due on the 1st. So again, bill your tuition, your rates before they actually happen. The summer cash flow planning worksheet, I just want to make sure you knew, includes a revenue stabilization section. Section 3, that's going to walk you through each of these 3 levers that we just talked about. And it's going to help you identify which one or 2 are most realistic for your business this summer. Now, you don't have to implement all 3 at once. Just identify your highest leverage option and start there. So your 2 action steps. Number 1, review your current summer enrollment policy. So if you offer week by week or those drop-in enrollments, draft a minimum commitment policy to pilot this summer. Maybe it's, if you don't do anything, it's an entire week. Or maybe it's you have to attend at least 4 weeks out of the summer. Whatever is reasonable and manageable for you to start with, and then write that new policy language. Even if you don't implement this till next summer, get thinking about it now. Action step number 2, download that summer cash flow planning worksheet at kellypeak.com, episode 185, and complete section 3, your revenue stabilization section, and identify one summer revenue lever you can activate or strengthen before your summer program begins, or if it's already beginning, at least so you can be aware of what's happening and be really ready to implement it next year. And write your plan in that worksheet and get going on that. Now, those 3 strategies, the mid-year cash flow reality check, building your summer cash flow buffer, and your summer revenue stabilization plan, that's the foundation of a summer financial experience that's going to feel like leadership instead of survival. Start with the reality check, because you cannot plan for what you don't understand, and then map out your numbers, calculate your gap, and write down your cash flow. That one afternoon of financial clarity, it's worth more than months of anxiety. Then build your buffer before you need it. Even a small, deliberately funded reserve, that can change the psychology of the experience of your summer anxiety dramatically. So stop scanning your bank account with fear and start checking it with confidence. Now, one thing I want you to do as well is identify one revenue stabilization lever you can pull this summer, because a smaller summer gap is always better than a perfectly managed large one. Now, the summer cash flow planning worksheet, that's your tool for all 3 of these strategies. It walks you through step by step that reality check. It's going to help you set those buffer targets. It's going to include that revenue stabilization section. It's going to help you find your best opportunity to close any gap you might have this summer. Again, go download that at kellypeak.com, episode 185. Now, if you're ready to go deeper on your business finance, I want to introduce you to the CEO Profit Spotlight Guide. This is a small offer designed to give you a 30-minute financial snapshot of your business. Where are you generating profit? Where might you be leaking profit? And the 1 or 2 adjustments that could make the most meaningful difference this summer and beyond. It's built specifically for early childhood business operators, which means it accounts for the ratio-dependent, seasonally variable financial realities that generic business finance advice often misses. You can go grab that at kellypeak.com under Shop Resources. So, my friend, here's one big action step for this week. Pull your numbers from the last 2 summers and build your revenue map. It's going to take a little time, but you will be so glad that you did this. And what you'll have on the other side is clarity about what summer actually looks like for your business, which is the first thing you need to stop letting it control you. You built this business to make a meaningful difference, and you deserve to lead it with confidence, even in the hard financial seasons. Summer does not have to feel like a threat. It can feel like a season you planned for. Lead it like the CEO that you are. Take care, my friend, and I will see you next week.